The live price of Opendoor Technologies Inc. Open is $9.52, reflecting a strong intraday move of over 5.0% today, pushing the stock from its open of $9.76 before it found its footing. This isn't just a simple up and down day. This is a stock that has been a battleground of volatility, and today's pop is a fresh chapter in a narrative defined by extremes. While the common investor might see this as a continuation of recent, mean-driven rallies, the real story lies in the profound shift in the company's strategic direction, a pivot away from its original capital-intensive model. The expectation has always been that Opendoor would either perfect its iBuying engine or collapse under the weight of a volatile housing market. Reality, however, is far more nuanced. The recent change at the top, with the appointment of a new CEO and the return of its co-founders to the board, has signaled an explicit move towards a more asset-light model. This is the core tension for Opendoor, the clash between its legacy identity as a tech-enabled home flipper and its new ambition to become a broader, more diversified real estate platform. For a long time, the dominant narrative around Opendoor was one of existential risk. Analysts and investors alike saw a company whose fortunes were inextricably tied to the whims of the housing market. High interest rates, low transaction volumes, and the risk of holding devaluing inventory were the constant threats that loomed large. This is a company that has been teetering on the edge of delisting, seeing its stock price plummet to a 52-week low of just 51 cents before this remarkable turnaround began. The conventional wisdom was that the iBuying model, while brilliant in a hot market, was fundamentally flawed in a downturn. But today, the conversation has shifted. This isn't just about a favorable tailwind. It's about a fundamental re-engineering of the company's DNA. The market is suddenly pricing in the possibility that Opendoor is not just a one-trick pony, but a more resilient entity capable of adapting to market realities. This is where the curiosity loop truly begins. What exactly does this strategic pivot entail, and is it enough to justify the explosive rally we've seen? It's a question of whether the new leadership can successfully transition from being a home-buying machine to a multifaceted platform. The daily trading volume for Opendoor has been explosive, with over 212 million shares traded today, a figure that is significantly above its average. This immense volume, coupled with the sharp price increase, points to heavy institutional and retail participation. There's a palpable sense of renewed interest, driven not just by the company's news, but also by broader market dynamics. We've seen similar movements in other high-beta speculative names across various sectors, like SoFi Invest. The high beta of Opendoor, which stands at an aggressive 4.66, indicates just how volatile and sensitive the stock is to market swings and speculative fervor. The stock's recent journey has been a testament to this volatility, from hitting a multi-year low to now trading near its 52-week high of $10.70. This massive swing is driven by the fact that Opendoor is one of the most heavily shorted stocks, with a significant percentage of its float held short. This creates the potential for a short squeeze, where a sudden surge in buying forces short sellers to cover their positions, pushing the price even higher in a feedback loop. This dynamic is what we often see in retail-driven rallies, and it adds another layer of complexity to the Opendoor narrative. The general belief about the company's business model is that it's all about iBuying, the process of using technology and data to make instant, all-cash offers on homes. In essence, Opendoor acts as a market maker for residential real estate. It provides a simple, convenient alternative for sellers who want to avoid the traditional, often cumbersome process of listing a home with an agent and dealing with showings and contingencies. After acquiring a property, Opendoor performs light renovations and then relists the home for sale, aiming to profit from the spread. This model, when it works, provides incredible speed and certainty. However, the contrarian take, and the reality that has been proven time and again, is that this model is deeply sensitive to the macroeconomic environment. A rising interest rate environment, like the one we've been in, directly impacts the company's ability to sell its inventory profitably. The value of the homes on its balance sheet can deteriorate rapidly, leading to significant losses. This is exactly what we saw in prior quarters, with the company reporting multi-hundred-million-dollar losses. The traditional model, as practiced by a company like Fidelity or an individual brokerage, which relies on a service fee or commission, is far less exposed to this kind of inventory risk. Opendoor's high-risk, high-reward strategy has been the central point of contention for both bulls and bears. The new leadership, however, is attempting to mitigate this risk. They are moving towards a more capital-light approach that includes services beyond direct purchases, such as a marketplace model and agent partnerships. This shift is designed to reduce the company's exposure to inventory risk and create more stable, predictable revenue streams. Whether they can execute this transition effectively is the central question that is fueling today's momentum. To understand the company, you have to look past the stock chart and into its core operations. Opendoors' revenue is primarily derived from the sale of homes. Its cost of revenue, which includes the purchase price of the home and any renovation costs, is substantial. Its goal is to achieve a positive contribution margin on each home sold, but this has been a challenge in a cooling market. Its recent financial reports have shown mixed signals. While it has managed to beat revenue expectations in some quarters, its guidance for future periods has often come in below analyst estimates, reflecting the ongoing headwinds. Opendoor has a high debt-to-equity ratio, which is a consequence of its inventory-heavy business model. It has to borrow a significant amount of capital to purchase homes. This is a key difference between a capital-intensive operation like Opendoor and a financial services giant like Fidelity Investments, which has a much more stable fee-based business model. Opendoor's profitability remains elusive, with analysts not expecting the company to achieve sustained positive earnings for at least the next few years. This is a critical point that the market often overlooks in the midst of a speculative rally. The company's recent rally has been driven more by sentiment and the promise of a strategic turnaround than by an immediate change in its fundamentals. It's a bet on the future, not a reflection of current profitability. The success of its new strategy will depend on its ability to leverage its technology, including its proprietary valuation algorithms, to make smarter acquisitions, and its new asset-light initiatives to generate profitable, non-inventory-based revenue. Looking ahead, the future of Opendoor is a high-stakes game of execution. The major catalyst for the stock will be the company's ability to demonstrate tangible progress on its new strategy. Investors will be watching for signs of reduced inventory risk, improving margins, and growth in its new capital-light business segments. The macroeconomic environment will also play a critical role. Any signs of falling interest rates or a stabilization in the housing market could provide a strong tailwind for the stock, validating the bullish thesis that the company can thrive in a more favorable environment. However, there are significant risks. A renewed downturn in the housing market or a failure to successfully pivot away from the iBuying model could lead to another painful correction. The company is still burning cash, and its path to profitability is long and uncertain. For those who invest online, it's a classic high-risk, high-reward proposition. It's a world away from the steady, dividend-paying stocks you might find in a Schwab Intelligent portfolio. It requires a deep understanding of market psychology and a high tolerance for risk. I'm curious to hear your thoughts on this. Comment below on whether you think Opendoor's strategic pivot is a stroke of genius or a desperate last-ditch effort to survive. Ultimately, the story of Opendoor Technologies is a perfect example of the tension between expectation and reality. The market's expectation, at least until recently, was that the company was a flawed concept, a victim of its own success in a housing boom, destined to fail in a cooling market. But the reality that is now unfolding is a different one, a narrative of adaptation and survival. The stock's dramatic rally, fueled by a leadership change and a strategic pivot, has forced investors to reevaluate their long-held beliefs. It's no longer just about the iBuying model. It's about a new business strategy, a new leadership team, and a high-stakes bet on the future of real estate technology. The journey from a low of 0.51 cents to its current level is not just a statistical anomaly, it is a market recalibration, a recognition that the story of Opendoor Technologies is far from over.